Hello friends, this is my 35th presentation for the team of Finance and Accounts, and the subject is uh, identifying causes that can adversely impact the financial reporting of the fixed assets in the balance sheet. This is part 2, which includes furniture, fixtures, vehicles and office equipment. Overall, this is my 66th presentation considering all the YouTube presentations that I have made so far. What I plan to include in this is the first is giving an overview of the causes which may be inaccuracy related or ethics related that can adversely impact financial reporting. Then separate analysis for the furniture and fixtures as type 4, vehicles as type 5, and office equipment as type 6. Now, for learning about three other type of fixed assets, namely land, buildings, and plant and machinery, please refer to my last presentation for the finance and accounts team. So this is an overview of the fixed assets, which is having 66 causes identified, out of which for furniture and fixtures 9 are the causes which are operational causes and accuracy related, and 11 are the ethical causes. Vehicles, there are 8 operational causes and 11 ethical related causes. Office equipment, there are 9 operational causes and 12 ethical related causes. So overall, 26 plus 34, that is 60 causes, and these causes are in addition to the 85 causes which were identified in my earlier presentation with respect to the land, building and plant and machinery. Now, in this case of each one of these, that is furniture, fixtures and vehicles, office equipments, I plan to include for covering the various aspects such as uh, uh, purchasing, acquisition of these, classification of these assets, revaluation, leasing of these assets, sales and depreciation aspects. Okay, now let's talk about F&M first. The examples of F&F are for first one, F is furniture, which can be of two types, which are standard design that can be ready to use, like tables and chairs for indoor outdoor usage, etc., and others that are against customized design. Second type, like kitchen cabinetry or wardrobes or beds or furniture for the conference room, etc. Fixtures. These may be used as fixtures for the lighting, bathroom, sales and marketing exhibitions related, etc., etc. Both and F&M can be custom design specification in terms of size, materials, shapes and colors. Now, list of operational causes that can adversely affect the financial reporting in the balance sheet. Purchasing of F&F. Inaccurate capturing of the expenses such as pre-dispatch inspection charges, the purchase price of F&F, including import duty, custom duty, and port charges in case of imports, and essential spares, freight and marine insurance, F&F handling, installation, testing, commissioning, expenses of the fixtures, and the cost of training employees, and essential spares and taxes thereof. Classification of F&F. Inaccurate classification of F&F with service cost centers such as offices or production areas or recreation rooms or restaurants or convention centers and different functions. Repair and cost, maintenance cost of the F&F. Inaccurate capturing of the cost of the bought-out spares and in-house parts spares, cost of labor for dismantling and reassembly and testing, etc. In case these costs are not appropriately captured, this can lead to incorrect financial reporting. Revaluation of the F&F. Incorrect or biased valuation methods not linked to the age condition of the F&F in terms of the comfort, F&F availability in the market of the required specification and market rates, etc., can also influence the financial reporting. F&F on lease. Now, lease can be either for the F&F given on lease to others or taken on lease from others. So, inaccurate capturing of the amounts towards this lease income or lease expenses. Inadequate documentation, for example, lease agreement and terms thereof, making the audit trail difficult and hence recording of these in the financial books. Seventh cause is depreciation related, which is applying inaccurate depreciation rates or understating the depreciation expenses among the different types of F&F. Disposal of the obsolete F&F. Insufficient documentation or support for the F&F sale transaction, such as approval note from the management for disposal, sales order or agreement for F&F, payment details and fixed asset register, etc. And ninth, the inadequate or non-timely documentation for the sale disposal of F&F. Ethical causes that can adversely affect the financial reporting in balance sheet. Purchasing related, underreporting or overstating the F&F value, colluding amongst the buyer, seller, and contractor, leading to the kickbacks in favor of the buyers, resulting in the paying unfair and higher prices for F&F, specifically for the customer design furniture and fixtures, and thus affecting the financial reporting adversely. Classification, no transparency in disclosing the changes in the financial F&F classifications. Repair and maintenance cost of F&F, colluding amongst the buyer seller, leading to kickbacks and favors to the buyers, resulting in the paying unfair and higher prices for the repair and maintenance expenses for the F&F. Lease of F&F, this is similar to the one which I had shared earlier, that is F&F given on lease or F&F taken on lease. Inadequate disclosures or hiding the unfavorable lease obligations, non-transparency in disclosing changes in the lease arrangements, non-disclosing the related party leases or manipulating lease terms for the F&F, incorrect reporting of the lease expenses incurred for F&F, depreciation for F&F, inconsistency in the depreciation rates on year-to-year basis, sale and disposal of F&F, negotiating lower sale prices for F&F not aligned to the depreciated value of the market rates or the market rates in return of the kickbacks, and lastly, insufficient and non-timely documentation or support for the F&F sale transaction, that is sales order, sale invoice, payment details, etc. Type 5, vehicles related operational causes that can adversely affect the financial reporting balance sheet. Purchasing of the new vehicles, inaccurate capturing of all expenses for the purchase of vehicles, including registration charges, insurances, rebates on vehicles, vehicle accessories, and documentation, etc. Documentation charges and taxes. Classification of the vehicles, inaccurate classification of the vehicles as commercial or non-commercial vehicle, chassis or chassis number or complete or passenger bus or truck, fire brigade, refrigerated vehicles, etc. for ambulance, etc. and so on. So proper classification is not done. Repair and maintenance cost of vehicles, inaccurate capturing of the cost of the borrowed spares and cost of the labor for dismantling and reassembly and testing of the vehicles. Revaluation of the vehicles, incorrect or biased valuation method not linked to the age condition of the vehicles in terms of mileage and performance and vehicle options, availability in the market of the models, capacity required, and the market rates. These can influence the revaluation of the vehicles. Operational causes continuing, vehicles on lease, inaccurate capturing of the amount towards lease income or lease expenses, inadequate documentation in terms of lease agreement and terms, making the audit trail difficult, and for the vehicles given on lease or taken on lease. Depreciation of the vehicles, applying inaccurate depreciation rates or understating depreciation expenses amongst the different types of vehicles. Disposal of the obsolete vehicles, insufficient documentation or support for vehicle sales transaction, for example approval note from the management for disposal or sales order of the or the agreement for the vehicles, fixed assets register, etc., and inadequate or non-timely documentation for the sale disposal. Ethical causes that can adversely affect the financial reporting in the balance sheet. Purchasing for the purchase related, underreporting or overstating vehicle value, colluding amongst the buyer seller, particularly for the specially vehicle which are built, leading to kickbacks, favors to buyers, resulting in the paying unfair and higher prices. Repair and maintenance of vehicles, colluding amongst the purchasers and service rendering workshop, leading to kickbacks and favors to purchase, resulting in the paying unfair and higher prices for the repair and maintenance expenses of the vehicles. Revaluation of the vehicles, overstating the value of the vehicles through revaluation. Lease of vehicles, inadequate disclosure or hiding of the unfavorable lease obligations or lease terms. Vehicles given for the vehicles given on the lease or vehicles taken on lease. Non-transparency in disclosing the changes in the lease arrangement for the vehicles. Non-disclosure of the related party transactions with respect to the leases or manipulating the lease terms for the vehicles. Incorrect reporting or lease expenses incurred for the vehicles, and depreciation of the vehicles. Under this head, the cause can be inconsistency in the depreciation rates on a year-to-year basis. for the sale and disposal of the vehicles, negotiating lower sale prices for vehicles not aligned to the depreciated value or the market rates in return of kickbacks, and insufficient and non-timely documentation or support for the vehicle sales transaction, like sales order, sales invoice, payment details, ownership, name change required of the statutory bodies, and the insured name. Type 6. Office equipment related operational causes that can affect the financial reporting and balance sheet. Purchasing of the new office equipment. Inaccurate capturing of the all expenses for the office equipment buying, such as purchase price, import duty, custom duty, port charges, and essential spares, freight and marine insurance, equipment handling and installation, testing and commissioning expenses, cost of training the employees, and spares and taxes. Classification of the office equipment. Inaccurate classification of the office equipment such as network servers, computers, printer, workstation, conference room equipment, etc. etc. Repair and maintenance of the equipment. Inaccurate capturing of the cost of the bought spares and labor. Revaluation of the office equipments. This is incorrect or biased valuation method not linked to the age condition of the office equipment in terms of efficiency and quality performance, office equipment availability in the market, or the models for the models and capacity which are required by the client, and the market rates. Leasing of the office equipment, similar to the F&F I had shared earlier, that is the lease income or the lease expenses, and inadequate documentation. Depreciation of the office equipment, applying inaccurate depreciation rates or understanding and understating the depreciation expenses among different type of office equipment. Disposal of the obsolete office equipment, insufficient documentation in support of the office equipment related to the sales transaction, like approval note from management before disposal, sales order agreement, office for the office equipment, payment details, and fixed register entries. Then inadequate or non-timely documentation for the sale disposal. Ethical causes that can adversely affect the financial reporting for the office equipment. Purchasing of the new office equipment, whether it is in fact it is new or old, so underreporting or overstating office equipment value, colliding amongst the buyer seller, leading to kickbacks and therefore reporting higher prices. Classification of the office equipment, non-transparency in disclosing the changes in the office equipment classification. Repair and maintenance cost for the office equipment, colluding amongst the buyer and seller, leading to kickbacks, resulting in paying unfair and higher prices for the repair and maintenance expenses. Revaluation of the office equipment, overstating the value of the office equipment through revaluation, non-transparency in disclosing changes in the office equipment, lease of office equipment, overstating the value of the office equipment through revaluation, non-transparency in disclosing changes in the office equipment values, inadequate disclosure or hiding the unfavorable lease obligations or lease terms and vis-a-vis office equipment given on lease or taken on lease. Then non-transparency in disclosing the changes in the lease agreement for the office equipment, and not disclosing related party leases or manipulating the lease terms for office equipment, and incorrect reporting of the lease expenses incurred for the office equipments. Depreciation of the office equipment, inconsistencies in the depreciation rates on a year-to-year basis. Sales disposal of office equipment, negotiating lower sale prices for office equipment that are not aligned to the depreciated value or the market rates in return for kickbacks, and insufficient and non-timely documentation or support for office equipment sale transaction, that is sales order, sales invoices, etc. So overall, let me just re-summarize. In this slide I have shared nine total 9 operational and 11 ethical causes for F&F, 8 operational and 11 ethical causes for vehicles, and 9 operational and 12 unethical causes for office equipment, totaling to 26 plus 24, that is 60 causes that can adversely impact the financial reporting in the balance sheet. Now my second book was released on 23, and now I'm working on the third book, and this blog of course is focused on the fixed assets part 2, namely F&F, vehicles and office equipment. And please wait for my my third book, forthcoming book, which will be focusing on the smart balance sheet strategies and ethical practices that can unlock the profitability. Please also refer to some of the articles of your interest in my website. Address is given here, and Facebook and LinkedIn. Thank you very much.